100% of GDP and continue rising more or less indefinitely. And wherever you draw the line, you've got to conclude that that's an unsustainable economic situation. So I think it's essential that Congress address this longer run budget deficit issue.
Time of the gentleman has expired. The chair now recognizes the gentleman from Texas, Mr. Green, ranking member of the Oversight and Investigation Subcommittee.
Thank you, Mr. Chairman. I thank Ms. Yellen for appearing today as well. And Mr. Chairman and Ms. Yellen, and of course, ranking member, I want you to know that there has not been some sort of conspiracy among Congressional Black Caucus members to bring up this issue of black unemployment, although I think we do talk about it among ourselves quite regularly. But I do believe that a basic premise that may be of help to us is the notion that in the beginning was the Word. And not enough talk takes place among those who have the power to influence public policy with reference to African American unemployment. To this end, I am concerned and would ask if you have in your statement given a specific reference to African American unemployment and the statement that you made today, and I apologize if I missed it, but was there a specific reference to African American unemployment?
I referenced in answer to a previous question the very high rates of unemployment of African Americans that persist even with the current aggregate unemployment.
If I may, let me share this thought with you. If it is, and I believe you are in agreement that it is a serious problem, not just a problem, but a serious problem.
I certainly agree with
If
that.
it is a serious problem, I would ask that you make it a part of your actual statement that you present and that you publish it and that you continue to say to those of us who can make a difference, and we should be able to make the difference here in Congress. We have responsibilities here to focus as well. But if you would make it a part of your statement, and if you would publish this, I think it can have a meaningful impact on policymakers up and down the line. So just a small request, but I think it can make a really big difference. So I'm going to ask that you do this.
I'm certainly open to doing so. I'll certainly take that seriously.
Now, let's move to the Taylor rule for just a moment. You have indicated that the Taylor rule would be a grave mistake and that it would be detrimental to the economy and the American people. Could you, in about 1 minute, give some examples or an example of how it would be detrimental to the economy? That's a sort of a nebulous term, and I think you should provide some clarity.
Well, sometimes it provides recommendations for what monetary policy should be that clearly overlook important circumstances. And
if I may, Madam Chair, would you kindly explain the impact that it will have on the economy? What would the impact be if it causes us to do something inappropriate? And I'll let you decide what's inappropriate.
Well, either it would have us set a monetary policy that would result in much higher unemployment than would be desirable, or alternatively, there could be circumstances in which it would recommend an accommodative policy that would result in extremely high inflation. Now, I would say right now, as an example, the Taylor rule would recommend an overnight short-term interest rate that would be close to 2.5%. And I think in light of the slow growth in the U.S. economy and the fact that we have needed to hold the federal funds rate for almost 7 years, at zero to achieve the progress that we have made, that setting it at the level that it would now recommend would be highly damaging to the economic situation. And we've tried to provide some analysis in the monetary policy report we submitted about why that is, and in particular this idea that the neutral Fed funds rate, because of the damage from the financial crisis and
I
other
regret that I
factors.
must reclaim my time because I have one additional thing that I must say. I appreciate your commentary, and I think that a good many people have the point. But I want to say this. We have some people who are visiting today. I don't want any response from them. But I want to acknowledge their presence because they're concerned about these wages. Now, they're concerned about wages across the board, especially as they impact working people, people who are on salaries, people who make minimum wage. And it's our desire to see policies that will have greater employment, greater opportunities, but also policies that will target those who are hurt the most. I thank you, Mr. Chairman. I yield back.
Me. The gentleman's time has expired. The chair now recognizes the gentleman from Pennsylvania, Mr. Rothfuss, for 5 minutes.
Thank you, Mr. Chairman. Welcome, Chair. I want to talk briefly about custody banks, which you know follow a different business. I understand that custody banks, whose customers would include, for example, pension funds with millions of beneficiaries, are finding it increasingly difficult to provide their core custody services, especially accepting large cash deposits. And this could worsen under a period of stress. One of the main reasons for this appears to be recent regulatory reforms, such as the supplementary leverage ratio, known as SLR. Custody banks typically place cash received on deposit with the Federal Reserve. This is cash that comes from pension funds, endowments, municipalities, and other clients. However, the Federal Reserve supplementary leverage ratio does not recognize the essentially riskless nature of Fed deposits or the necessity of these placements by custodians. This may cause the leading custody banks to reject customer cash deposit. My question is the Federal Reserve aware of the impact that this may be having on custody banks? And if so, what do you propose to do about it?
Well, this is something that was considered what is the appropriate treatment of central bank deposits when the supplementary leverage ratio was adopted. And a decision was made at the time that the leverage ratio is not our main capital tool, but a backup capital tool that is intended to, in a crude kind of way, base capital requirements on the overall size of a firm's balance sheet, and that for that reason it should be included. We have more recently put in place capital surcharges that apply to the 8 largest U.S. banking organizations, including 2 custody banks, and it's likely that once those are in place that they will become the binding capital requirement. But
Well, I would encourage you to take a look at that because it's an issue for the bank.
You've heard of the problem, and I will.
As you
discuss
know,
it.
Chair Yellen, the Bank of Japan recently announced that it would implement a negative interest rate policy in an effort to increase spending and investment and spur growth. The decision follows close on the heels of the European Central Bank's announcement that it would also launch additional monetary stimulus in March. And economists have predicted that Sweden, Denmark, Norway, Canada, Australia, and China may follow suit. In a recent editorial in the Wall Street Journal, William Pohl, the former president of the Federal Reserve Bank of St. Louis, argued that these sorts of monetary policy gimmicks will not create their intended effects, and instead, they will only serve to divert attention from the actual structural problems that have plagued growth in the U.S. and around the world over the last decades, namely regulatory burdens and
Factors that have restrained U.S. growth and also been responsible for rising inequality in the labor market. And it's important to take steps to address those problems. They're steps that are in the domain of Congress. But it's important for the Fed to try to achieve its mandate of having, ensuring a state of the labor market where people who want to work are able to find jobs, where there are a sufficient number of them, and given the stress situations that exist in Europe, where there remains very high unemployment, and in Japan, where inflation has, for well over a decade, undershot their inflation
I wanna-
objective.
I
It's
wanna-
a tool that has proven useful to
Well,
them.
I want to talk a little bit, you testified earlier, over the past number of years, the Fed kept federal funds rate at exceptionally low levels. And with that, you testified that even with this, quote, exceptional, close quote, strategy, the economy achieved only 2% growth. And you added, quote, economy is being held back by headwinds. I'm wondering if any of these headwinds are man-made, or to borrow a phrase, anthropogenic here in the United States. And I could identify some. The Affordable Care Act, a Wall Street reform bill that missed the mark, frankly, EPA regulations, and these headwinds have hit folks in my district, like a mom who now has to pay $400 for allergy medicine for her kid when she used to pay $10. Or the coal miner I talked to last week who's taking care of a 5-year-old, a 3-year-old, and 1-year-old won't be able to pay for his mortgage. And I just wonder, when the economic history of this decade is written, are they going to say that the Fed tried to do with monetary policy what should have been done with fiscal policy?
Well, I think it's also important for Congress to address structural factors that are holding down growth.
Time of the gentleman has expired. The chair now recognizes the gentleman from Missouri, Mr. Cleaver, ranking member of our Housing and Insurance Subcommittee.
Thank you, Mr. Chairman. Thank you for being here, Madam Chair. Following through on